Welcome back to Confident Real Estate. I'm your host, JC, and I'm going to assume that you clicked on this video because you're investing your free time watching YouTube videos so you can strengthen your investing strategies and make stronger investments for your portfolio, especially when it comes to real estate investments. So today, we're going to dissect and answer the age-old question of what constitutes a good cash-on-cash return. And if you're not familiar with how to actually calculate a cash-on-cash return, don't even sweat it because we're going to cover that first. And we're going to run through a real-life example of how you can leverage financing to get a better cash-on-cash return. Then we're going to look at what constitutes a good cash-on-cash return on average. And lastly, if you're capable of sticking around all the way to the end of the video, we're going to compare cash-on-cash returns against some other basic metrics that you really should be considering anytime you do an investment, especially in real estate. So stick with us to the end because it's going to be worth your while. Now, before we get started, you know what to do. You got to hit that like button down below. It is completely free, like all of the content that we're giving you on this video and every other video that we put out on the Confident Real Estate YouTube channel. So hit like, hit subscribe if you haven't already, and let's get into it. In case you don't know, evaluating your cash-on-cash return is an important piece of the puzzle that you should be doing every time you analyze a deal for a rental property or a property that you're going to flip. It will tell you just how hard your money is going to be working for you compared against other investment opportunities. So what exactly is a cash-on-cash return? Basically, it's the amount of cash you should expect to take back every year from the cash you invested in the property. Because remember, every dollar that you put out into an investment is an employee who works for you. And their job is to go out and make you more money. That's the expectation. So the more employees you have out there, the more money they're going to make for you. Now, you may be thinking, isn't this the same thing as that ROI that I always hear people talking about? No, an ROI stands for a return on investment, and it looks at the whole investment and accounts for any debt that you may have on the deal as well. Whereas a cash-on-cash return only looks at the amount of cash you are going to take back in, or that you should expect to take back in based on the cash that you've actually put into the deal. It's actual cash returns compared to the amount of actual cash you put in. So now let's actually run an example and show you how to calculate some cash-on-cash returns. The basic formula is cash-on-cash returns equal the net operating income divided by the total cash you invested multiplied by 100%. So let's say you purchase a rental property for $100,000, but you only put 20% down in cash, which is $20,000. And you take out a mortgage for the rest, the other $80,000. But let's not forget those closing costs, so we'll use nice round numbers and say you pay $5,000 in closing costs for a total of a $25,000 cash amount that you have now invested in the deal. $80,000 in mortgage, $25,000 in cash for a total of $105,000. Now your net operating income on your pre-tax profit after you take in rental income but deduct your operating expenses and your mortgage payments is $3,000 per year. To get your cash-on-cash return, you would divide that $3,000 by the $25,000 in actual cash that you've put into the deal, and that will show you that you're going to get a 12% cash-on-cash return. If you buy the property all cash with no mortgage, you would have $105,000 in cash in the deal, $100,000 to buy the property, plus the same $5,000 in closing costs, but your net operating income would be higher because you wouldn't have a debt service expense, which is just another term for mortgage payments. So let's say that you made your net operating income $8,500 annually because you don't have any mortgage to pay. Divide $8,500 by $105,000 in actual cash that you have invested in this deal, and you're going to have an 8% cash-on-cash return. This cash-on-cash return can obviously fluctuate over the course of time that you own your property. in the event you have one-time capital improvements or other large expenses such as fixing a roof. But don't forget that your rental income should also be going up over time as well. So now that you know how to calculate a cash on cash return, what constitutes a good cash on cash return? Well, an 8% return is pretty darn good by most investment standards, but especially if you can leverage it with a mortgage and increase it to 12%, that's spectacular. Compare that to stock market returns that average slightly less than the 8%. Again, and it should be obvious, you want to maximize the cash on cash return that you can get when you're investing in real estate, because investments in real estate require you to go out and find the deal, invest in the deal, manage the deal, and increase the value of the property over the time that you're holding it. It's a bit more work than just buying some stocks, but the return can also be quite a bit more as well. It's important to remember, though, that when it comes to real estate investing, a cash on cash return analysis does not account for your equity appreciation that you will gain in the property or the real estate tax depreciation that you can take on your investment in the property, which do affect your overall return on investment, that ROI we talked about earlier. Achieving higher cash on cash returns really is dependent upon where you choose to invest and the type of properties that you buy. For example, buying a Class C or D property, which are typically older and in less desirable neighborhoods, also typically come with higher cash on cash returns than properties in more desirable neighborhoods that have a higher price point and will require you to put a lot more cash into the deal because of that higher price point. That said, Class C and D properties tend to require more attention, but they come with the opportunity to add value by doing some renovations or major capital improvement projects, filling tenant vacancies, and then raising the rents to closer to market value. They definitely come with more headaches and are riskier investments than a turnkey property that's at the top of the market, already stabilized in a wonderful neighborhood, but you're not going to get nearly the return on that wonderful stabilized property that you could get from a Class C or D property if you're willing to put in the work. Remember that managing your real estate investments, even if you hire a good property manager to handle the day-to-day issues, is still going to require more of your time and attention than simply parking your cash in some index fund and letting it sit there and generate a return. That said, on top of the cash on cash return that you would get from a stock investment and a real estate investment, real estate also comes with equity appreciation in the value of your property, your asset, as well as real estate depreciation that you can take off your tax return, which allows you to keep more of your income than returns you would get on a stock investment. So calculate that as well into your overall picture when you're determining where you want to invest your money and why real estate is worth the extra effort and attention to invest in. That said, that brings us to the last part of this video, which is the other metrics you should be doing whenever you're considering an investment opportunity. Aside from your cash on cash return, you should also be calculating your net operating income, which is essentially your net profits after deducting your actual expenses to operate the property, as well as any mortgage payments that you have to make. You should also be calculating your after repair value and equity appreciation rate by doing some after repair value comparables, those comps that we did an entire video on. I'll leave the link down below for you. That is something that you absolutely need to calculate if you're planning to do any form of renovation or capital improvement work to the property after you buy it. Perhaps your IRR, or internal rate of return, which is more often used when you're buying commercial real estate and you have an uneven cash flow or a depreciating asset. And also, if you're buying commercial property, you should be considering the cap rate, because more often commercial properties are based on the value of their income rather than the standard comparable methods that we would use by preparing comps when we're buying residential property. Dissecting some of these other metrics is another topic for another day in another video. My hope is that you now feel confident in your understanding and ability to calculate a cash on cash return pretty quickly when you're evaluating your next investment deal. I appreciate you making it all the way to the end. Like I said at the top of the video, I assume you clicked on this because you're looking for a little bit of additional information to make stronger investments for your portfolio. So I hope you got something out of it. Click like if you did, and if you haven't already, if you haven't hit subscribe yet at this point, now's the time to do it because we got a lot of great videos on deck and you definitely don't want to miss any of those. And you might as well check us out on Instagram too, where I post some articles of real world things that are actually happening that are related to the topics we discuss here on this channel. As always, I appreciate it. Thanks for watching Confident Real Estate, and we'll see you next time.